Today, I'll share with you a full stock analysis on the world's largest chip makers and semiconductor producer that has gained over 200% of value since the beginning of the year. And so you'll discover if it's a great time or not to buy the Nvidia stock with the ticker NVDA. As always, I'll start by analyzing what is their business model, so how are they able to generate the biggest chunk of their total revenue and who are their different customers. And after, I'll make a quick fundamental analysis followed by a price prediction to see if this company is currently under or overvalued at the moment. So without further ado, let's dive into it right now. Nvidia is an American multinational created in 1993 that is now based in California and that is mainly focusing on the creation and the production of graphic processing units, as well as application programming interface and a system on the chip units that is mainly used for the mobile computing and automotive market. In fact, over the years, Nvidia has become a dominant supplier of artificial intelligence hardware and softwares for different companies all around the world, and it has recently become the first chip makers producers to reach a valuation of over $1 trillion.
Nice.
But now, let's see how Nvidia has been able to generate over $26 billion of revenue in 2023. First, you need to understand that Nvidia's revenue can be divided in 4 big branches. You have the data centers branch, which is mainly focused on producing and giving great solutions for data centers. From AI and data analytics to high-performance computing to rendering, data centers are key to solve some of the most important challenges in our society. For the first quarter of 2023, this Nvidia's branch has been able to generate about $4.2 billion of revenue, which represent about 60% of the total revenue of Nvidia for that period, and which is also up of about 14% compared to the same period but in 2022. Now, the second branch of Nvidia's products and services is the gaming branch. This part of the business is particularly appreciated and well known by all the gamers worldwide because of their famous GeForce, which is a famous graphic processing unit that is mainly used for computers. On its side, this part of the business has been able to generate about $2.24 billion of revenue over the last quarter of 2023, which represent about 31% of the total revenue of Nvidia. However, the revenue of this branch has been diminishing of about 38% compared to the same period in 2022. Now, the third branch is the professional visualization. This part of the business is developing great cutting-edge products, telling immersive stories, and reimagining cities of the future. In their latest quarterly report, they have notably announced the coming of the Nvidia Omniverse Cloud, and that is mainly used for the development and the deployment of industrial metaverse applications. However, this only represent a mere portion of the total revenues generated by Nvidia over the last quarter, with some revenue of about $295 million generated, which only covers about 4% of the total revenue of Nvidia. And unfortunately for that branch as well, the total revenue has been down of about 53% year over year. And finally, the last branch is the automotive subsidiary. As you can understand by its name, this branch is mainly focusing its efforts on the autonomous driving, and by working with professionals in the field, they've been able to produce the first NVIDIA Drive platform, which has the objective to cover everything in that field from the data centers to the autonomous driving. But on its side, this part of the business isn't the biggest cash cow of Nvidia's, where it has generated about $296 million of revenue over the last quarter, which actually also represent about 4% of the total revenue generated by Nvidia. But compared to the professional visualization branch, this part of the business has been up of about 116% year over year. Now that you have a better understanding of what are the different products and services that Nvidia is offering, well, you can understand that their business model is mainly focused on the future and on the technology field. Indeed, even if the majority of their income is coming from the data centers and the gaming branches, I personally believe that in the next couple of decades, with the EV revolution that is coming to our door, companies like Nvidia and all the semiconductors companies will see some massive growth. In fact, if you didn't know, all the companies that want to produce electric vehicles need to have different chips in their cars, and we've seen that since the beginning of the pandemic, those chips have become a rare commodity. And so one of the biggest problems of this branch of Nvidia is to be able to produce enough of those chips. And it is also one of the reasons why this branch has gained over 100% of growth in their total revenue because of the scarcity of those products. This can be proved by the recent earnings report of Tesla, where its CEO Elon Musk has praised the quality of Nvidia's products. In fact, Musk has even said that Tesla was using a lot of the different hardware and software from Nvidia because of their quality. And Musk even said that if Nvidia was able to increase the productions of GPUs, they were gonna buy even more of those. So as you can see, Nvidia's products are well recognized for being some of the best products that you can find on the market. On your side, if you wanted to invest in an electric vehicle companies, you can obviously opt for the traditional options, so Tesla, NIO, or Fisker, or you could decide to invest directly in Nvidia. But as I told you earlier, with all the recent popularity that they have gained, they have obviously gained a lot of value over the last couple of months. So right now, the biggest problem of Nvidia is that they are kind of victims of their success. And so it is why you can see that they have gained over 200% of value, as I told you earlier. So in that case, is it a great time or not to buy the Nvidia stocks? Well, it is going to be the question that I'll be answering right now into the fundamental analysis. In terms of valuation, you can see that this company currently worth a whopping $1.12 trillion, which actually makes it one of the largest companies in the world by market capitalization. But looking at different valuation metrics such as the price to earnings ratio of over 200, a price to earnings growth ratio of over 2, and a price to sales ratio of over 40, you can see that this company is massively overvalued on that side. Nevertheless, over the last 12 months, you can see that they've been able to achieve some great profit margin as well as an excellent operating margin and some excellent return on equity for the investors of over 18%. And over that same period, they have generated some revenue of close to $26 billion, however, with a small drop of about 13% in their latest quarterly revenue growth compared to the same quarter but in 2022, but with an excellent earnings growth of about 26% over the last quarter. And a good news for this company since the hike of the interest rate is that they currently have more cash with about $15 billion in cash compared to about $12 billion in debt. In terms of the volatility of this company represented by the beta on a 5 years period, you can see that it is way more volatile than the market with a beta of close to 2, meaning that it will tend to fluctuate about 2 times more than the overall market. Add to this, you can see that this company is giving some super small dividend of about 0.04% to their shareholders, with obviously a super low payout ratio of only 8%, meaning that in the future, if they wanted to increase the dividends, well, they will have a lot of possibility to do it. And in terms of the total revenue progression over the last 3 years, you can see that they've been able to grow their revenue quite well. But unfortunately, you can also see that the total expenses of this company have massively grew, which has led to a diminution in their total earnings before interest and taxes compared to 2022. And the picture is quite similar in terms of their operating cash flow, where you can see a certain spike in 2022 where it has reached about $9 billion of operating cash flow. And this has been translated perfectly into their free cash flow, where you can see a slight diminution in the first quarter of 2023. And finally, to determine what is the true value of this business, we'll be using many different evaluation models to help us with this task. As always, I'll start by using the Peter Lynch valuation model, which is a simple formula where you come add the future growth of the earnings per share with the dividend yield and that you come divide by the price to earnings ratio. And as you can see by the result, this company would currently be massively overvalued with this valuation model. Unfortunately, since Nvidia isn't focusing its energy on growing its dividend, as you can see with an average growth rate in their dividend of less than 2% over the last 5 years, well, we won't be able to use the dividend discounted model to evaluate the true intrinsic value of this business. And finally, I'll be using the classical discounted cash flow model to evaluate what is the value of this business with its different cash flow. But first, we need to find what is our weighted average cost of capital, where we'll find it by analyzing what is the cost of debt, the cost of equity, the cost of debt and equity, and our weighted average cost of capital is about close to 12%. And with all the input that I will insert in this grid, you can see that this stock would currently be also massively overvalued. At the end of the day, as a value investor, I would personally not invest in that particular business right now, especially with the rapid recent rise that they've seen in their valuation. Because as you can see by all the fundamental metrics and all the price prediction models, this company would currently be considered as overvalued. And in my opinion, when I decide to invest in individual stocks, I invest in them because they are undervalued on my point of view. But in their case, I could definitely see them as being in the top 10 of the largest companies in the world over the next couple of years. But since it isn't currently undervalued, I wouldn't consider it on my watch list right now. But talking about great undervalued companies, if you're looking for the best stocks to buy right now, check out the video that's going to be right over here, and I will see you soon. Peace!